Today I'm going to give you a breakdown of how much you need in dividend stocks, what you should buy potentially to be able to retire. You probably clicked on this video because you're thinking exactly how I was. How much money do I need to quit my job and never have to work again? Because financial independence and retiring early have more people interested in them every year, people want to know what they have to do to leave their job and retire now. Now, I'm not a financial advisor and I definitely can't tell you how to retire today, but this is what I figured out through research and trying to figure out my own plan. By the end of this video, I'm going to hopefully get you up to speed with everything I know so you can build your own plan for retiring off of dividends. But first, let me talk about what dividends really are.
Well, now, tell me, what are dividends?
So when you buy stock in a company, it's basically like you're becoming a part owner in that company, even if it's just $1 in a $2.8 trillion company like Apple. When Apple earns a profit, they have two ways that they can use this profit. One, they can invest it back in research and development for the next iPhone, adding a fourth camera next time, or they can give it back to their shareholders. And if you've got that $1 in Apple stock, that's coming back to you. And that's what a dividend is. Basically them paying out their excess profits on top of whatever they need to operate the company back to their shareholders. So it's kind of like building confidence in the company and giving them a reward for owning part of the company and investing in them in the first place. So just by owning even $1 of a company, you'll get paid. And usually that happens every quarter. Some dividend stocks pay monthly, but not all companies actually pay dividends. It's not a requirement at all. Often these early stage companies that are focused on growth, when I said there's two options, they're putting all that money back into research and development. If they're still trying to build their company, it makes more sense for them to take that money and put it back in their business, which actually, if you're just looking at it from an investing perspective, can still make a lot of sense. The more mature companies that have already established themselves usually use dividends as a way to return those profits back to investors, since they're not really in need of super investing into research and development now that they're more established. Generally, the way you represent how many dividends or how much dividends a company pays is the dividend yield. This is basically a percentage of the company's stock price that gets paid out in dividends over the course of the year. So if you have a 5% dividend yield on a company stock that costs, say, $100, that's $5 in dividends throughout the course of the year. And like I said, split into 4 quarters, so it's basically $1.25 every quarter in that example. When you receive these dividends, you have two options for what to do with them. First, you can use that dividend money and just rebuy more of that company stock. So if you get $5 in dividends, you can say, okay, I'll buy $5 more of that company stock. This is usually called the dividend reinvestment plan, or DRIP is what you'll see it in a lot of stock apps. Most brokerages support this, and you can just flip it on usually in the settings. The other thing you can do with that money is take it as a little payday for yourself and put it in your pocket. And if you're thinking about retiring off of your dividend money, this is probably what you'll do in that case. While you're building up your portfolio, you'll take that money, keep investing it back into the stocks, DRIP, so that your portfolio gets bigger and bigger. But once you're ready to retire, you can start collecting those dividends and using them to buy Starbucks, your trip to Italy, whatever you want. The nice thing about dividends is you never have to sell any of your stocks to be able to collect money. Your stocks can keep appreciating in value while you're just collecting paychecks. Okay, cool. Now you're ready to start building your dividend portfolio. Hopefully this is going to be something that you can fund your life for good with, so you're probably wondering what are good dividend stocks to buy. Alright, before I get into talking about any specific stocks, it's important to call out again, I'm not a financial advisor. You shouldn't just buy stocks that I name here. You should do your own research and buy stocks that you feel confident in. And it's important to call out with dividends, there's no guarantee that a company that has paid dividends for a long time will continue paying dividends. There are plenty of companies that pay dividends consistently for 30 years. They run into financial troubles, they go bankrupt. Obviously, they can't pay dividends if they go bankrupt. Or maybe they run into hardship, they don't have the profits the same way anymore to continue paying dividends. So it's always important, just as with normal investing, to diversify your dividend portfolio. If you're relying just on one company's dividend to pay your rent, suddenly they run into problems, they're not paying you anymore, then you're not paying your landlord anymore. For me, I always like to stick to pretty simple investing tactics that don't require me to check the financial news every morning or every afternoon, but still allow me to get a good return in the market. So you have a couple options for how to start building your dividend portfolio. The first option is to not build a dividend portfolio at all. You could follow a lot of the generic investment advice by investing in the S&P 500 or a total stock market index, like people like Warren Buffett and Jack Bogle, the founder of Vanguard, recommend. And even these ETFs pay a dividend yield, so you'll still be able to collect some dividends while following sort of the normal standard investing advice. When the S&P 500 paid out its dividends in June of 2023, it paid 90 cents per share. So it's on track to pay out about $3.60 over the course of the year for every share of the S&P 500 that you have. That's a yield of about 1.5%, and you're probably wondering, 1.5%, that doesn't sound like too much, and really it's not if you're looking at stocks that are focused on delivering dividends. But 1.5% is a good sort of starting place to think about, okay, if I was just investing in the S&P 500, I'd get 1.5% in dividend yield. Now you have something to compare to. Now let's talk about some of the other stocks that are focused specifically on giving dividends. If you're looking to build out a portfolio of dividend stocks that are meant to carry you through the long run, you're going to want stocks that are consistent, have a high yield, and have a proven track record over the course of maybe 20, 30 years even. So some of the kings of dividend stocks are actually called the dividend aristocrats. This is a name given to stocks that are, one, part of the S&P 500, two, have given dividends consistently over the course of 25 years, and three, have risen their dividends over time consistently. So these are companies that are reliable, trustworthy, and probably some that you've heard of. Right now, there are 65 companies that technically qualify as dividend aristocrats. These include companies like AT&T, ExxonMobil, and IBM. So, like I said, older, more established companies, but that have a proven track record of being able to bring in a profit every year. There's some companies that have even given dividends consistently, increasing over time for the last 50 years, like Coca-Cola, Target, Pepsi, and Procter & Gamble. And again, you're seeing a trend here. These companies stay consistent like this because they're in stable industries, have staple goods, and have proven a track record over the course of many decades. So if you're looking for a group of stocks that pays super consistent dividend income that is increasing over time, the dividend aristocrats are a good thing to look at, and you have a lot of stocks to choose from. Now, if you kind of want to combine the two, index investing and dividend stocks, there is a middle ground, and this is through dividend ETFs. An ETF is basically, you buy a share of one stock, but that's really like buying a share of a bunch of other different stocks. So the S&P 500, if you buy an S&P 500 stock, you're actually buying a small share in 500 companies. And the same is true for the dividend ETFs. Some of the most popular dividend ETFs are SCHD, VYM, and SPYD. There's loads of other ones, but those three range anywhere from 3% to almost 5% in dividend yield. And like I said, it owns a basket of high dividend paying companies, so you're already diversified just by buying that stock. Now, if you're like me, you probably Googled top dividend paying stocks and you saw stuff like JEPI, JEPQ, QYLD. These are not quite as simple as, owning a share of a company or owning an ETF. These are pretty advanced instruments, some of them using like covered calls. It's not something I can explain in this video, but when you're looking at dividend paying stocks, there's a tendency to kind of look for just the highest yield, but really make sure you understand what you're investing in and you know what you're getting yourself into. Some of these are, sacrificing all gains at the cost of a little bit more dividend yield, which can be good. It can pay a lot of dividends. 10% sounds great, but you just got to be careful, know what you're investing in, and do your own research. For today's numbers, I'm going to look at a couple different example portfolios with different dividend yields, anywhere from just buying the S&P 500 at 1.5% up to using these 10% advanced instruments. Now, let's get to the big question, the reason you clicked on the video. How much money do you need to retire just off the dividends? All right, so before we do the math here, there's two questions you have to answer for yourself. One, how much do you want to spend every year? And two, what's the dividend yield of your portfolio going to look like? First one, spending. I can't help you there. You know what you spend. If you're not tracking your expenses, it's a good time to start. But in general, after retirement, people spend about 80% of what they spent before. If you want to ball out in retirement, spend, $1 million a year, you need to account for that. For today, I'm going to look at three different scenarios. $30,000 a year, which is living pretty tight, but potentially doable. $67,000 a year, which is the average household spending in 2021, according to Bankrate. And then $100,000 a year, which is, living pretty comfortably, 6 figures a year as your income should be pretty nice. And then for the dividend yield of these made up portfolios, I'm going to start with 1.5%, which is the yield of the S&P 500. If you're following the normal investing advice and you just have a bunch of S&P 500, this is how much you could get in dividends per year. And then I'll also have 3%, 5%, and 10% to give some of those kind of rough dividend stocks and ETFs and advanced instruments I talked about earlier as an example. The actual numbers are super simple. So if you want to do any of these calculations yourself with whatever numbers you land on, you definitely can. Basically, you just need to divide your yearly desired income by the dividend yield of your portfolio, and then you get how much money you need to be able to earn that every year. So then, of course, we can just start plugging in the numbers that I mentioned. All right, I definitely cannot remember all of the numbers exactly, so I'm going to use my laptop. $30,000 per year in income from a 1.5% dividend yield portfolio, you'd need $2 million invested. If you had a 3% dividend yield portfolio, that drops down to $1,600,000. If you had a 5% yield, and at 10%, you'd only need $300,000. Again, $30,000 a year is super tight, but just to kind of give you the baseline. Also, again, having a higher dividend yield definitely doesn't mean it's a better investment for you. It just means it pays more dividends. S&P 500 is a super reliable investment, and it only pays 1.5%. Cool. And if you wanted to earn the average household spending income, which is $67,000 per year, if you had a portfolio that paid 1.5% dividend yield just from the dividends, you would need $4.46 million invested to be able to pay your yearly expenses. You'd need $2.23 million at 3%, $1.34 million at 5%, and $670,000 at 10%. So again, the more heavily you index into the dividend yield, your stocks are probably gaining less in value. But if you don't want to sell any of your stocks, you just want to live off the dividends, that's what the numbers would look like. And finally, if you want to earn $100,000 per year, you really want to ball out, you would need $6.6 million invested at a 1.5% dividend yield to be able to earn that much every year. At 3%, you would need $3.3 million, $2 million at 5%, and then you'd only need $1 million if it was paying 10% a year. You can do the math there. 10% of $1 million is 100,000. Realistically, any of these lower yielding portfolios, you'd probably want to be selling off some of your stocks because you'd expect that they would be gaining. But just looking at the dividends, that's what the numbers look like. Now is a great time to call out that there are definitely some risks with investing just in high dividend yield. Specifically, companies that are focused on paying high dividends, generally they're more mature, established, they're not focused on growth, and you really see that in the stock price. Generally, companies that pay high dividends don't always see the biggest growth over time. So you won't see a company like Tesla blowing up the stock price if it's, a company that is focusing on paying high dividends. Again, they're not investing as much money in R&D. They're still great companies. They're super consistent oftentimes, but they might not see as much growth historically over time. It's also, again, super important to make sure you're diversified. These companies that are focused just on providing dividends, even if that's their main focus, if they run into financial troubles and they can't pay dividends anymore or they have to decrease them, could have been super consistent over the course of the last 30 years, and then the day you need to pay rent, they can't pay their dividend, and you're screwed. So it's always important to diversify, as with any investing. Again, you've absolutely seen this everywhere online, but investing in index funds like the S&P 500 or a total stock market ETF and reinvesting the dividends in those, that's the most consistent, surefire way to get your return in the market. I'm focusing just on dividends here. It's your call here, do your own research. For me, I don't necessarily focus all on dividends. I focus more on growth, and then I'm okay with selling off some of my stocks if I wanted to retire or, take some money out of my portfolio. But if you really want to focus just on stable income, not selling your stocks, just on dividends, these are some of the techniques and things you should look at. But again, there's a reason people like Warren Buffett, Jack Bogle have really focused on index funds because they're super consistent, super reliable, and you don't really have to think at all. So there you have it. To live fully off the dividends, you need anywhere from $300,000 to $6.6 million invested. Now, these sound huge to me, and I'm sure probably to you too, but if you start today, you get consistent, those can get a lot closer than you think. And if you liked what you saw today, feel free to subscribe, drop a like, let me know down below what you want to see from me next, and what are you investing in? All right.